Adobe stock just released their earnings. Now will the company Photoshop some positive returns on their share price? Hi, I'm John from ValueGlance.com. I have a PhD in theoretical physics. I've worked as a research analyst on an 11-figure fund, and I'm the author of Stop Checking the Price, a book where we explore how to find high-quality companies that win in the long run. Today we're going to take a look at Adobe. The stock is down 33% in the last year, down 26% in the last 5 years. That's not exactly AI hype momentum for a company that continues to add AI to its offerings. After a strong earnings report, the nonsense news is focusing on the future of AI for Adobe, ticker ADBE. What will happen to Adobe subscriptions if there's fewer jobs and fewer people using Adobe products? What about younger companies like OpenAI or Canva in the creative design space incorporating AI to compete with Adobe's business model? What does the future look like? And so rather than getting caught up in the nonsense news headlines and the latest short-term hype, let's look at long-term trends of key fundamental metrics to analyze Adobe stock. Let's start off by looking at profitability. So here we are at ValueGlance.com looking at Adobe, and we're looking at the data over the last 10 years here. And what we can see is the ROIC plotted in blue compared to the weighted average cost of capital in orange. So remember that we want a high, steady, and ideally increasing ROIC, the return on invested capital, when compared to the weighted average cost of capital. The WACC, the weighted average cost of capital, sets the bar. It's the hurdle that the ROIC needs to clear for the business to create long-term value. And so we see here for Adobe that the ROIC has been high, it has been steady, and we see has even been increasing. And so that's what we like to see for a high quality business. What about invested capital? So we can go down here, we can add in the invested capital. And we see over this time period, it's been relatively flat. And so even though the ROIC is coming up the past few quarters, we see the invested capital hasn't grown much. Now, a high-quality compounder stock is one that continues to aggressively reinvest earnings. And so we expect to see not only the ROIC high and steady, but an invested capital that is also growing. And so in the case of Adobe, we see the invested capital has only grown 3% over the last 5 years, 3% annualized, CAGR. So not exactly a compounder stock, but nonetheless, we see from ROIC a quality business. Now, in the case of Adobe, we can see that the business, if we add in shares here, shares outstanding, we could see the shares have been coming down. So the business has been buying back stock. Remember, buybacks are another way of the company to give value to shareholders in contrast to dividends. By buying back shares from the market, the remaining shareholders own a larger slice of the pie. And so in that case, invested capital would go down, equity actually goes down for the business. And so that's part of the compensation here. And we see shares have been bought back at a level of 2.4% annualized over the past 5 years. And so working the numbers out, that's a 12.9% boost to shareholder value by buying back shares. So that was our quick quality analysis, but what about the value? And in particular, does the quality justify the hype? And so here at ValueGlance, we can go ahead, click on the value button. And so what we're showing here is the hype factor here in green and the equilibrium hype in pink. And so the hype factor we can think of as a multiple. It's the multiple that the market is willing to pay on top of the invested capital on the company's books. And so if the company has $1 of book value for the invested capital and a hype factor of 5, that means the market is valuing that $1 of invested capital at $5. So it's like a price to book ratio, but it's including both equity and debt that the business is putting to work. And so here we see the hype factor for Adobe has been on a wild ride the past few years, peaking here at over 16x. It has come down and we see now it's finally cooling off. The value is still above the long-term equilibrium hype, but nonetheless, we are seeing it moving back down from the stratosphere. And so the current value we see is about 8.7 compared to an equilibrium of 5.9. So let's put this in perspective. We see the last time that the hype factor was this low was the end of 2022 at a similar level. If we go ahead and add in the price there, we see the next year, so 2023, large returns. So 70% plus returns the following year, the the last time the hype factor was this low. That doesn't mean history will repeat itself, but it does help show that the hype level has cooled off from those past highs over the last 5 years. Okay, let's go ahead and look at another value metric, free cash flow yield. So we can plot free cash flow yield here. And what we see is that in the most recent year, the past few quarters, free cash flow yield has been shooting up here. And it is at a value now of over 6%. And so free cash flow yield is telling us how much free cash flow the business is generating compared to the share price. And so at 6%, that means the business is generating $6 worth of cash flow for $100 worth of shares. Free cash flow yield therefore gives us a great valuation metric to say what are we getting out in terms of cash relative to what we're putting in. And so we see the last time the free cash flow yield was this high was, we have to go back to here, 2013 to see the free cash flow yield at this level. And the returns there, if we were to plot the price, the returns the following year were about 50%. So again, history doesn't repeat itself, but we do see that companies go through cycles. And we're seeing that for Adobe by looking at these long-term trends. Quality businesses can go up and down through hype cycles, and by playing the other side of the hype, we can cash in. The long-term trends tell us that it's a high-quality business, but that it's not a compounder stock in terms of aggressively reinvesting profits that would manifest as a growing invested capital. So we don't quite see that for Adobe, but we do see the hype cycles. And the hype factor, while still not in deep value territory, has cooled off somewhat. So if the company can maintain a high quality, then the purchasing price today is certainly a lot better than it was 5 years ago at these elevated hype levels. So does this mean that one investor's deflating hype balloon is another investor's opportunity? What do you think about Adobe? Remember, no one can predict the future, especially in the near term. But by looking at these long-term trends, we can ignore the nonsense news headlines and the short-term hype. So invest for the long term and keep compounding knowledge.